Canada ranks amongst the largest tax countries in the entire world, where in 2022, the total tax bill of the average Canadian family accounted to 45.3% of its household income. So, is there a legal way to pay less tax? The answer is yes, and in this video you'll discover how as a Canadian you can reduce your total tax bracket and at the same time receive more money in your pocket. So the first way for you to reduce your total taxes is for you to contribute in different saving programs offered by the government. The first program that you can use to reduce your total taxes is the Registered Retirement Savings Plan, aka the RRSP. Since 1957, this account has been created to help and promote savings for retirement for employees and self-employed people. It is why all the money that you'll earn and that you'll put in this account will stay tax-free until you decide to withdraw this money, for example, at your retirement. And so when you'll decide to withdraw money from this account, you'll be taxed at that time at your current imposition bracket. However, for us, what is particularly interesting if you want to reduce your total taxes is the fact that all the contributions that you'll be putting in this program will be all deductibles on your total earned income. Plus, knowing that you can contribute up to 18% of your earned income in the previous year up to an annual RRSP limit of $30,780 in 2023, you can also decide to take all your unused contributions that you've built through times and use it in the future, for example, when you'll be earning more money, meaning that you'll be taxed more on your total income. Then the second program that is pretty interesting for you if you're looking to lower your total taxes is the First Home Savings Account, aka the FHSA. This new program created in 2023 has the objective to help all the young Canadians to purchase their first house. Basically, it gives you the possibility to contribute up to $8,000 per year to a maximum of $40,000 in this tax-free program that has both the characteristics of a TFSA and of a RRSP. Indeed, just like the RRSP, this program has the characteristic to help you to reduce your total tax imposition on your current income that you are earning. And it has the characteristic of the TFSA because all the money that you'll be able to earn in this account will stay tax-free even when you will withdraw the money to purchase your first property. Add to this, all the contributions are cumulative, meaning that you can use them when you want up to the maximum fixed to $40,000. So it will not only help a bunch of different Canadians to save a lot of money in taxes, but it will also help them to purchase their first house in an extremely unaffordable market for many young people. But keep in mind that to be eligible for this type of program, you need to have not owned any types of properties over the last couple of years. Obviously, as a Canadian, you also have other alternatives in terms of programs such as the tax-free savings account, but in the way that it doesn't help you to save any taxes, well, I won't be talking about it in this particular video. Now, another way for you to reduce your total tax bracket is to deduct different admissible expenses to your earned income. Our objective with that will be to decrease your total earned income and at the same time reduce your total taxes. If you have young kids, for example, you could be eligible for the childcare expenses deductions. So you can claim tax deductible childcare expenses paid to day nursery schools and daycare centers such as nannies, babysitters, and day camps. There are, however, certain limitations to who can claim this particular expense. In a two-parent household, for example, only the spouse or the common law partner with the lower net income can claim the childcare expenses. On your side, you could also claim different medical expenses to your total taxable income. For example, dental visits and prescription fees could definitely be deductibles. Did you also know that if you did relocate for more than 40 kilometers for work, you might also be eligible for moving expenses? Indeed, if you moved either to work or run a business or to be a student in full-time attendance in a post-secondary program, you could notably be eligible to deduct different travel costs. Another great way for you to lower your total tax bracket is to check what are the different credits that you can claim. Indeed, in Canada, we are pretty lucky. We have plenty of different credits that are available for all Canadians of all ages that can help them to reduce their total taxable income. If you suffer from a serious and prolonged physical or mental impairment, you could notably be accessible for a disability tax credit. If you are a post-secondary student here in Canada, you could also potentially be eligible for the tuition tax credit. This one will help you to cover a certain percentage that is fixed to about 15% of your total costs, including tuition and eligible fees. However, your costs per educational institutions must be at least $100. And in Canada, it pays to be generous since you are eligible when you are doing any donations towards any types of charity to receive a tax credit for it. So as you can see, there are plenty of great ways on how you can reduce your total taxes that you are paying in Canada. Now let's see what is the last one that will be covered in this video, which is the interest that you are paying. When we think about interest payments, it is often seen with some bad eyes, but not from a fiscal point of view. Indeed, if you currently have a student loan and that you are paying some interest on it, you should be able to reduce a certain portion of it on your total income. To help students and graduates offset some of the financial burden of repaying student loans, the CRA offers a deduction for qualifying student loan interest payments. So you can carry forward all the unclaimed interest payments that you've made on your student loans for the next 5 years. Plus, if you are a real estate investors and that you have invested in a rental property that is generating some income, you could also be eligible to reduce a certain portion of the interest on your mortgage on your total taxable income. So the great thing with financial knowledge is the fact that it can help you to save thousands and thousands of dollars by implementing the right strategy. But talking about investing strategy, if on your side you're looking forward to find how I've been able to buy my first rental property at 24 years old, well, check out the video that's gonna be right over here, and I will see you soon. Peace!